So today we're diving into a scenario that some are calling the World War III of finance. It's a really dramatic, very detailed look at how a new global conflict could play out, not with armies and tanks, but with gold bars. Let's dig into what the source has to say.
Right off the bat, the source material hits you with this powerful hook. The claim is that a new kind of global conflict isn't just on the horizon, it's already started. A war that's being fought not on a battlefield, but on the balance sheets of the world's central banks.
Okay, so if a financial war has begun, what was the first shot? Well, according to this source, it all kicks off with an event that it calls the Gold Declaration.
The source gets super specific here, setting the scene on a near-future date, January 15, 2026. The idea is that at a press conference in Beijing that seems totally routine, a tiny 47-word announcement is made, and in this narrative, that single sentence changes absolutely everything.
And this is the core of it. A simple invitation for other countries to park their gold in China. Now, on the surface, that just sounds like a business offer, right? But the source argues this is a direct challenge to the Western financial system, which has been the world's gold vault for decades. So how in the world does a simple offer turn into a financial weapon? Well, according to the source, it's all about the massive infrastructure that was supposedly built in secret to back it all up.
At the heart of this entire strategy is what's called the Shanghai Gold Vault system. The source explains this isn't just another building, it's a whole new financial ecosystem, and it's been designed from the ground up to be way more attractive than the old options in London and New York. And what's just mind-blowing here is the sheer scale. China didn't just build a competitor, it built an absolute giant. This chart shows Shanghai's capacity at a staggering 3 billion ounces. That's more than double the capacity of London and New York combined.
But it's not just about size. The source points to some key advantages. First off, the type of storage. Shanghai apparently offers segregated and allocated storage. In simple terms, that means your country's gold bars are physically separate, with your name on them. This gets rid of the risk that your gold might have been loaned out or mixed with someone else's, which is a concern some have with the Western pooled system. Second, and this is a huge point in the source's argument, is insurance against seizure. You know, after Western nations froze $300 billion in Russian assets, other central banks got pretty nervous. So China's system apparently tackles that fear head-on by offering explicit insurance, saying your assets can't be confiscated. And third, actually getting your gold back when you ask for it. The source points to the fact that Germany had to wait years to get its gold back from the US Federal Reserve. It's a huge weak spot. In contrast, Shanghai is said to guarantee physical delivery of the gold anywhere in the world within 90 days. That's a game changer.
But look, according to the source, all those features, the size, the insurance, the speed, that's not the real weapon. The real weapon is the fine print. By requiring all transactions and contracts to be settled in its own currency, the renminbi, China isn't just offering a storage service, it's creating an entire gold-backed financial system that operates completely outside of the US dollar's influence.
So this new system, according to the story, is like lighting a fuse. The source then lays out this incredibly fast-paced, dramatic 8-month timeline showing exactly how the dollar's dominance could completely unravel. Okay, let's walk through this domino effect. It starts quietly in January with that announcement, but then, boom, by March, Saudi Arabia reportedly moves its gold, and the dollar takes a hit. In April, other Asian nations follow suit, and U.S. borrowing costs spike. By June, the big BRICS nations join in, and the stock market tumbles. But the real shocker comes in July when Germany, a major U.S. ally, supposedly makes a pilot transfer. By August, it's too late. The Fed's emergency actions fail, and the dollar crosses a critical line in the sand.
So, what happens when that tipping point is finally reached? The source then details the absolutely catastrophic consequences for the U.S. economy once the dollar loses that special status it's had for so long. And this chart illustrates that moment perfectly. The dollar's share of global reserves, which started about 56%, finally slips below that 50% threshold. Psychologically, that's huge. It's no longer the world's undisputed reserve currency, it's just one among several.
And once that line is crossed, the source predicts a massive, global sell-off of dollar assets held by other countries. And the total value? A mind-boggling $33 trillion. It's a stampede for the exits.
So what happens when $33 trillion comes flooding back onto the market? The outcome described is simple, and it's devastating. Hyperinflation. The currency that you save in, that you earn in, just loses its value at a terrifying speed. It basically destroys wealth and the entire economy. And to make this really hit home, the source gives this painful example.
Imagine you have $100,000 in savings. With the kind of inflation this scenario predicts, in just 3 years, its actual buying power would be a little over half that. Over 40% of your savings just gone.
Okay, so after painting this pretty grim picture, the source doesn't just leave you there. It pivots to a very specific, actionable playbook that it says individuals can use to protect their wealth if a crisis like this were to happen.
Here are the 5 key strategies it recommends. First, own hard assets, things like physical gold and silver that tend to hold their value when paper currencies fail. Second is a bit counterintuitive. Use fixed-rate debt. The idea is you'll pay back things like your mortgage with dollars that are worth way less in the future. Third, get out of cash. Keep maybe a 6-month emergency fund, but convert the rest. Fourth, if you have a business, don't just accept dollars. Diversify your revenue streams. And finally, build skills in professions that are devaluation-proof, like skilled trades, tech, and healthcare. And that brings us to the final, really provocative thought from this source material. By framing this whole thing not as something that might happen, but as a war that is already here, it leaves you with a very direct and pretty urgent question. If this scenario is even partially right, are you positioned for the fallout?